I've spent over 3 decades in the market as floor trader, equity derivatives market maker, and as bank prop trader. On a long-term basis, the market remains in a structural uptrend. The quarterly chart shows no regime break whatsoever. Momentum has been cooled at times, but trend integrity has been preserved. What matters here isn't whether the market is overbought in the short term, it's that pullbacks over the last cycle have remained corrective and not distributive. The 1-month time frame shows where that long-term trend has become more extended and more sensitive to marginal changes in liquidity and in sentiment. This is the zone where momentum still exists, but risk becomes more asymmetric. Not because the trend has ended, but because expectations are already elevated. And on the weekly chart, you can see the market working through the tension. Consolidations, sharp pullbacks, and recoveries, all within the same broader structure. This is typically where positioning and sentiment matter more than fundamentals in the short run. Taken together, the charts don't tell you what will happen next. They tell you what kind of market you're operating in. The secular trend is intact. However, we are working through some tensions, and the market is clearly on a technically elevated level. Now let's talk about the elephant in the room: stock market valuation. This is the Shiller-Cape ratio, a cyclically adjusted price-to-earnings measure that smooths earnings over a full business cycle. What stands out immediately is that today's level, just above 40, sits at the extreme right tail of history. As a matter of fact, this is the second highest level we have seen in history. The highest was recorded just before the internet bubble burst in 2000, and another extreme being witnessed just before the stock market crash in 1929. The question here is not whether the equity market can stay or can get more expensive in the short run. It can. The more relevant question is what that starting point has historically meant for long-term outcomes. Each dot here represents a historical starting point, the Shiller-Cape valuation level at the time and the real return investors experienced over the following 10 years. There's a wide range of outcomes. Valuation doesn't time markets. But the relationship is clear. As starting valuations rise, long-term return potential compresses. At the current Cape levels, the market sits on the far right of this distribution. That doesn't mean negative returns are guaranteed. It means the margin for error is smaller. That being said, historically there hasn't been one single instance at the current Shiller-Cape ratio level or higher where the stock market experienced a positive real return over the following 10 years. The Shiller-Cape ratio tells you how expensive equities are relative to their own earnings base. Let's add a second perspective that looks at the market from a more macro angle. The Buffett indicator steps back even further, comparing the market to the size of the economy itself. The Buffett indicator compares the total market value of equities to the size of the underlying economy. In simple terms, it asks how large is the stock market relative to what the economy produces. Historically, this ratio has tended to oscillate around a long-term baseline, rising during valuation expansions and compressing after major market resets. Today, that ratio is well above its historical average, and at the upper end of the range we have seen over the past several decades. Just like the Shiller-Cape ratio, this isn't a timing tool. Markets can stay elevated for extended periods. But as a valuation signal, it tells us something important about starting conditions. When we translate that ratio into valuation zones, today's reading lands firmly in the significantly overvalued range. That doesn't tell us what happens next month, but it does help frame expectations over the coming years. What matters here is not any single metric. It's consistency across different lenses. The Shiller-Cape ratio and the Buffett indicator are telling a similar story. Valuations are elevated relative to history. With that backdrop, it's worth looking at how markets have tended to behave historically during this phase of the presidential cycle. What you are seeing here is the stock market performance during the most recent historical presidential midterm years, rebased to the same starting point in January. Each thin line represents a different midterm cycle. The thick red line is the current market, plotted alongside that historical range. The key takeaway here isn't direction, it's volatility. Historically, midterm years have been more volatile than average. Drawdowns tend to be deeper, swings wider, and uncertainty more persistent. particularly earlier in the year. That pattern has been documented across multiple studies and market cycles, and it reflects a combination of political uncertainty, policy risk, and tighter financial conditions. Seasonality doesn't override valuations or macro fundamentals, but when valuations are elevated and positioning matters, it can help frame risk and expectations rather than point predictions. So to sum it all up, technically markets are elevated. From a valuation perspective, they're significantly stretched, both on earnings and on a broader macro basis. And seasonally, history points to a higher likelihood of increased volatility over the next 12 months. Put together, that suggests that we may be in for a bumpier ride in 2026. I will be tracking that process closely, and I'm looking forward to navigating it with you here on this channel. If this kind of content is useful to you, you may want to subscribe. Thanks for watching.